Hello and welcome to SwitzerTV Investing. I'm Peter Switzer, and following a huge 5% sell-off of the stock market on Friday, and after watching Warren Buffett on TV on Sunday, well, I was in bed at the time, I must admit, let's test out the idea that there might be a big leg down again for the stock market. To do that, we'll catch up with Julia Lee from Berman Invest, and then we'll toss the big question around with Charlie Aiken of Aiken Investment Management and Paul Rickard of the Switzer Report. And then I'm going to catch up with the CEO of McPherson Limited, Laurie Mccallister. This is an extraordinary company doing very well, seems to be beating the stock market negativity of the coronavirus. And then we listen to the CEO of a company that Julia Lee really likes called EML. We talked to the CEO of that company, Todd Cregan. This is a really interesting show with some real opportunities. And I think we do get to the heart of the matter of whether there is going to be a big leg down for the stock market. So without any further ado, let's catch up with Julia Lee. Well, we always kick off the program with Julia Lee from Berman Invest, and we want to see what she's seeing now. I must ask you this question. Did you set the alarm for 6:45 and watch Warren Buffett on Sunday morning, Julia?
I was resting, but I did read up on what he was saying. And, you know, he's one of the legends of the market. And it was really interesting, especially what he said around the cash balances and also how it had moved from year to year. So taking a view that the longer the expansion, the more cash he would be holding. So a legend of the market and I guess all cashed up now.
Yeah. Do you think he was alluding to the fact that he thinks there's going to be another leg down? Or do you think, he often says, I don't know where the market's going to go one day, 2
I think
weeks.
one of the measures that he likes to use is earnings growth versus GDP. And if you have a look at that measure for the US stock market, that's one of the highest valuations that you've ever seen in that area. So he is very much a fundamental value type of guy. And I guess if you have a look at crises like this, in the past, they don't resolve in a year. They usually do take a little bit longer. The global financial crisis, we peaked in November 2007 and didn't bottom out till March 2009. And even the tech wreck over in the US, that blew up in 2000 and the market really didn't bottom until 2003.
Yeah. All right, so that's the Buffett part for you. What about the sell-off on Friday? What did you think of that?
Well, Friday was a special day. It was May Day, which means a lot of markets around the world were actually closed. So it did look like the US was going to have a negative session. We did see US futures down. And if investors wanted to position before that US session opened, Australia was one of the few places where they could take risk off the table. And I think that's exactly what we saw. We saw those losses accelerate and actually close at the lows. We were down 5% on Friday. And then in the US, we saw the market down 2.8%. So given that the US stock market didn't fare as badly as the Australian market, we probably saw some of those positions being reversed today. And instead, we saw strength today rather than weakness. So a lot of the pain, we actually foresaw those losses on the US stock market and then really normalized in trading today.
Now, you and I talk a lot, so I could be getting this wrong, but have you started to show some interest in local banks because of what they've been doing lately?
Well, I think the banks had been under a bit of a cloud that we could see capital raisings coming through. Now, we did see a capital raising come through for NAB, but it looks like Westpac won't be raising funds. They have deferred their dividend and we have seen first half cash profit plummeting by about 70%, but Westpac's still in a pretty good capital position. So the fact that capital raisings do seem to be off the table means that some of that discount because of the anticipation of a discounted capital raising is coming out of share prices. So in the short term, it looks like the banks are going to have a bit of a breather, and then the rest of it really depends on what this recovery looks like. If we start to see recovery in the fourth quarter of this year and continue to see recovery, I think that would be a great scenario for the banks. If we do see a longer dragged out recovery throughout 2021, then the bank recovery in share prices will also be prolonged.
My recollection of whenever banks cut dividends or reduce dividends or whatever, when things start getting better, they often overcompensate and give some nice dividend surprises. Is that the kind of thing you'd expect if the economic comeback towards the end of this year is bigger and better than expected?
Look, we have seen a deferral in dividends, so it doesn't mean that these dividends aren't going to be paid. It means that the decision is being deferred into the future when the banks get a better idea of what's happening. It was fascinating seeing a Westpac's result today, and just the amount of support that they're offering to their customers, especially in the mortgage area. It came to, I think it was $39 billion worth of loan balances being deferred, and that made up about 9% of the total in mortgage loans. So it's a huge amount that's coming through. A lot of this provisioning hasn't happened yet. So look, if the provisioning that they've put aside is less than anticipated, well, then we're going to have positive payback in future periods.
I guess if the big four banks don't do what ME Bank or ME Bank did in terms of rifling people's withdrawals, redrawal facilities, they might come out of this with a much improved reputation, Julia.
And I think that's the key. The banks in past crises, the way they've managed their client base has either made customers for life or turned customers against particular brands for life. So this support package is as much about trying to retain a loyal customer base in the midst of some structural changes happening in the industry, where we are seeing digital transformation and technology moving at a much faster pace. But I mean, bank prices where they're at the moment, they do look fairly attractive, and the bounce looks like it's got a little bit more legs to go. The more medium-term story, though, does depend on recovery and how much we see in terms of unemployment, because that's really going to affect mortgages.
Last year, I know you were a great fan of a company called EML, and I've interviewed the CEO for later in the program. What do you think of EML at this point in time, Julia?
I really like this company. I know there's going to be more short-term pain ahead because it does have a big exposure to that retail space. EML is some company that does prepaid cards. It looks at gift cards that are used in shopping and for retail. It also looks at, casino winnings when you top up cards like that, and gaming. And also they just made an acquisition over in Europe, which I think is quite an exciting one, because it means that they'll be able to offer financial services and white label financial services for a lot of fintechs. And look, they've managed to buy that at a reduced price because of what's happening with market volatility and COVID-19. So look, I'm very positive on this business 2 to 3 years out. I think that Christmas sales this year could be a pretty poor period for a lot of retailers, and that's undoubtedly going to reflect on EML as well. Okay,
so is there a company that you like right now? You're sitting at home basically doing nothing. But I know you trawl the markets looking for companies that you like. Is there a company right now that's sticking out for you?
There's plenty of companies that I like, Pete. I don't know if they're all at the right prices. I guess having a look at some of the companies that have been doing well that I'm happy to add to at the moment, Evolution Mining is one of them. It's been doing quite well, but look, with an all-in sustaining cost for the full year of below 1,000 Australian an ounce and gold prices being above 1,000, it's probably going to pay about a 3% dividend yield. So, finding dividends in unlikely places is probably going to be the theme of 2020 for income investors, and gold certainly is one area where earnings growth is happening and happening quite strongly. So we're likely to see stocks like that. The other area that's interesting, but probably where I'm holding off a bit because I think we'll see more capital raisings in the property space, are the shopping centres, which aren't necessarily the huge shopping malls, but the smaller neighbourhood shopping centres, which are anchored by supermarkets. So Charter Hall Retail just recently did a capital raising. Anchor clients like Coles, Woolworths, Aldi's, they make up about 50% of income. And then if we have a look across the rest of their portfolio, liquor and food make up another 12%. and then medical and pharmacies makes up another 7%. So about 70% of the income that they get from their portfolio is actually quite defensive, and 87% of their portfolio is still trading. And of course, that will ramp up as those lockdowns come out. I guess the areas that are under pressure are bricks and mortar apparel, and that makes up about 5% of Chatter Hall Retail's portfolio. And then the other area is services, which makes up about 7%. So look, I think that's an interesting one given the discount that the market's applying to all shopping centres at this space. I don't think all shopping centres are created equally, and I think some of those neighbourhood ones which are anchored by supermarkets, look, they're looking like good value at the moment.
Great stuff, Julia. As always, thanks for joining us.
Thanks, Pete.
Well, here we are again. We're still in lockdown mode and socially distanced as always, but we've all been affected by, the fact that the market really got clobbered on Friday, down 5%, and then along comes Buffett on the weekend. He's kind of, well, I don't know whether he's made as positive or negative. Let's just see what my expert buddies think. Paul Rickard from the Switzer Report and Charlie Aiken from Aiken Investment Management. Charlie, has Buffett made you positive or negative on the market?
Neither. I thought he was very sensible as usual. I thought most of his anecdotes and his advice were sensible. He is considered a sage for those reasons. Look, as I said last week, recently bought some Berkshire Hathaway shares. He's very well positioned. I think he's pragmatic too. He sold out of airlines because he saw a structural change. I think that was pragmatic. But to read into that too much is going a bit too far. His airline holdings were $4 billion in value. His Apple holding is $55 billion. His market cap is $440 billion of Berkshire Hathaway. So
it's a small percentage.
It's a very small percentage, the airline thing. A small mistake he made, but he's sitting on $137 billion of cash. And one of the reasons I like him and his shares is what he will do with that cash over the next year or so. He will find a deal to do, or many deals to do. But I think he was just slightly beaten to the punch by the Fed's quick action in March. So it was all heading his way to deploy that capital, but the Fed moved very, very quickly and markets rebounded. But I thought, as per usual with Buffett, it was very sensible stuff.
Look, I think it's probably more bullish than bearish, Pete. Again, I agree with Charlie. Pretty sensible stuff. Big on sort of America and the strength of America. And don't fight America. I think
bet on the USA.
Bet on the USA. And look, still saying that I can't tell where the market's going to be tomorrow or in 2 years' time. But I know in 5 years' time, in 10 years' time, in 20 years' time, it's going to be higher. And so a good reminder to all the long-term investors out there that Buffett's still ready and still backing that.
The farcical thing is that his investments are marked to market, so they report a $50 billion loss. It's not like crystallised loss. That's the new accounting standard in America. His operating income for his businesses was actually up 6% for the quarter, which was quite a very good effort considering it involves a train business, an insurance business, multiple energy businesses and obviously financial holdings.
I think coming back to our market, Peter, look, don't read too much into Friday. Friday was about...
Explain Friday.
Well, there are a number of...
There's a portent of another big crash.
Factors at work at Friday and today. First of all, Friday was the start of a month and followed two fairly... innocuous, quite deep rises on low volume on 2 days before. So it's almost like the market got pushed up in Australia on the Wednesday, the Thursday for a bit of end of month, I won't say window dressing, but a bit of...
Why wouldn't you say window dressing?
Well, probably a bit of window dressing. Certainly
well, it was a coincidence. It went up the last day of the month.
Friday was the first day of the month, right? A day when short positions get reset. It also followed a week lead from the US, and we had, after the bell on Thursday night in the US, we had both Amazon and Apple. Reported a bit disappointingly. So, expectation the US was going to be down. And then it just built on itself, Peter. It was the end of the month. Start of the month. I think it was just one of those weak Friday afternoons that a lot of investors have pulled out of. And so they were expecting worse from Wall Street. We got a small fall on Wall Street, 2 or 3%. Came in this morning. I don't think it's a surprise the market's up today.
Okay, well, both you and I thought the market would be up today.
After a fairly weak start.
But the part of the reason why I thought that was, well, Wall Street didn't carry on and drop 5% like we did. Charlie, do you think sometimes when we see the Dow futures down, that instantly has negativity to our market?
I would give any advice to anyone, never ever look at US futures in the Asian time zone. I think they're totally irrelevant. They may prove...
But they do...
They do. They have an influence in the region because people look at them and think they mean something. I mean, there's so many times in my career, US futures have been up or down, and that indicates the opening of Wall Street, not where it closes. So it's probably going to be right-ish to where it opens, but not where it closes. So I think they're a very bad indicator of what is actually going to happen on the night. And I think they're best ignored, but the region doesn't ignore them. So I think, to me, US futures are down today, but Australia's up. Okay. So who knows?
Let me give you another Buffett interpretation by a young fund manager who will remain nameless. But when he saw the Buffett thing, he thought this was a sign that Buffett expects another leg down because he's cashed up and he hasn't bought anything already. Now, I have my own view on that. What do you think, Charlie? Do you think he's waiting for another big leg down?
And he may, look, we all think there could be another leggish down. Like there could be. I mean, who knows what happens in the next 3 or 6 months? And having a bit of firepower, like we've said in the Switzer Report, is fine to have a bit of cash to deploy. Whether it's capital raisings or a market pullback, you're ready to deploy. I think that's sensible. But when in Buffett's league, to turn the dial at Berkshire Hathaway, you need to deploy 20, 30, 40 billion in a hit. In a deal. And that deal will come to him. He's not going to just put 137 billion straight into the share market on a day. So he's waiting for deals that are on his terms. So I don't interpret it either way, other than he made a call on airlines, which is probably right, actually, in terms of exiting those. Structurally,
at least for 2 years.
But the cash thing I don't read anyway, other than I do understand that some people would say that, he's obviously bearish because he hasn't deployed the cash, but I don't think that's correct.
Paul?
Yeah, I didn't take it that way, Peter. I mean, I think the tone was still pretty upbeat, and I would just interpret it as being, well, look, he's got some cash. He hasn't found the right thing. It was like he was saying, we don't really know what we want to invest in, and as he keeps saying, it's not really about price for him. It's about the quality of the business, and so I think
the good companies are actually, a lot of them are higher in price now than they were before the crash.
Well, if you think about the tech side of things, like one reason the NASDAQ market is pretty close to unchanged on the year is the earnings reports from Microsoft, Apple, Amazon, Alphabet, Facebook, Netflix, Atlassian, the Australian one, and Spotify even, were all excellent.
And these are the companies that he might want to buy, but they
were excellent. And most at an all-time high. Amazon is, give or take, after a 2-day movement, pretty close to an all-time high. Apple's within $30 of an all-time. Like most of the very dominant tech stocks are very much closer to their highs than any recent.
Okay, let's talk banks locally now. So Westpac has said no dividend for you.
Well, I've got to correct you, Peter. It's deferred the dividend, which probably means no dividend. But let's just give the Gonski and the new guy at
Peter King, he's a
and he's very active as chairman, a bit of benefit of doubt, and take it, McFarlane, and take it on face value and say, look, the dividend is deferred and they're going to look at it again in a couple of months' time. So it could come back on the agenda. Look, I guess it was always safest for Westpac to defer it, and if you actually look at the earnings, using any measure today after their write-off, it was less than 30 cents a share. So there wasn't much potentially to pay out to shareholders.
Okay, but if this, a lot of this is based on the worst case scenario from the.
Well, it's based on their scenarios. I mean, each of the major banks has done multiple scenarios, right, and assigned a probability weighting to a whole lot of forecasts, ranging from the key variables being what's the unemployment rate, how much a home loan price is going to drop, and how much does GDP drop, all right? And the timing of such, and whether it's a V shape or an L shape or a U shape.
There's also the view shape as well. You're V and going to a U.
They've got lots, not just one model, they have lots of scenarios, and they put a probability weighting across those scenarios. So they have the base case, which has got a 50% probability, whatever it is, and they have an extreme case, which might have a 10% probability, and a less bearish case, which has 20%. And that's what it's based on.
I reckon
and they'll change those forecasts and they'll change those weightings, Peter. So this is just...
And they could change their dividend?
Absolutely. It's a number... It's really put sticking your hand up and to say, what could it be, right?
Okay. But I think though you do have to put in context that they're the ultimate insider. They know exactly what is happening with loan defaults, non-repayments, mortgages not being serviced right now. And that what they can see right now, which we all know is horrific, is a good enough reason to defer the dividend. That doesn't mean it's the future, but they know, and the board is, I think the boards of ANZ and Westpac made the right decisions. Don't give some people some paltry dividend, preserve the balance sheet, keep the capital, let's see how this plays out. And it's the right...
You sound like a bank director.
He is sounding like a bank director.
No, I think it's actually the right decision. But the bit for me...
They would say that too.
And I think eventually they will pay that deferred dividend in some form. Now, you might get a better full-year dividend or whatever it is, okay? But for me, the biggest issue with this is actually people who rely on income not getting it.
Yeah.
So for retail stocks and discretionary stocks in Australia, I think it's a problem in terms of those bank dividends make up a lot of, retirement saving income.
And that's why
that's the bigger problem for me.
And that's why they should be diversified in their dividend harvesting, and that's why the Switzer Dividend Growth Fund was a very good idea.
Yeah, I mean, I think
Nice plug, by the way.
Yeah, good segue.
Very
That's true.
Good
That's
plug.
why we created it.
And dividend yields this year, we're going to look at 2s to 3s on average across the market. Now that they've had deferral, that also IAG out today saying it probably wouldn't pay its final dividend in September. So there's a lot of there are a lot of companies either putting it off or deferring it. Fortunately, the resources companies are going to save us on the dividends.
Well, until we get into this big fight with China, we've got to be very careful here.
That's right.
Very careful here with China.
And I don't disagree, Charlie, but they're probably going to save us. But
because you might be called Chinese Charlie.
Well, no, I'm just reading the inverted commas tea leaves. This is really escalating, and the biggest thing we've got to worry about in markets is probably USA versus China again. The blame game, the onshoring.
That was the other reason for Friday's sell-off. A little bit of talk around that. But
should we go long Vale then?
No. I just think we need to be aware that there's going to be a big blame game about this COVID-19 virus, and we're in an election year in America, and we're going to be pushing for onshoring of American manufacturing, and there's going to be some slightly tougher stuff here, I reckon.
Okay, that's all the highbrow stuff. Our viewers like a stock. You mentioned Spotify.
Yeah.
Have you been interested in Spotify, Charlie?
No, I don't think the music stream. Look, it had a good result the other day because everyone's sitting at home downloading everything. But I think the music stream.
Collette actually tipped it at the Sons conference.
Yeah, I think the music streaming business is a bit different to the sort of video streaming business because at the end of the day, the music labels actually make most of the money, not the distribution company as such. But look, it's interesting. All those stay-at-home players are done brilliantly, right? Spotify, Netflix, Amazon. It's obvious. But I mean, the stuff I'm more interested in is like what is actually going to change permanently after this? And it will be a little bit more working from home or remote contact with your peer group, probably a little bit less travel to go to conferences and things like that. You can do it on Zoom. So, I mean, Spotify fits into that. I don't own Spotify. We own Netflix and Amazon and things, which are a bit obvious. But I'm trying to work out what the world looks like in 6 to 12 months from now, because some of the changes we're seeing in our lives now will be somewhat permanent, or to a degree permanent.
Well, at least for 2 or 3 years.
Yeah, just a little bit different. So,
mean reversion, we might become travellers once again. But
look,
for a
while,
we
all want to travel, but it's going to take a bit of time.
Yeah.
Like, we're not going to be travelling much.
Paul?
Look, I've been on the sidelines, Peter. I'm with Charlie. I think there's going to be some quite deep structural changes here in terms of industries. One thing I'm not bullish about, Peter, is travel. I really caution on this travel stuff.
You won't go Webjet or Flight Centre,
I won't go Webjet or Flight Centre. I think there's going to be some real changes in this stuff, right? And until we see international travel open up, I think you've got to be extremely careful in any of the travel stocks. I don't think they've seen all the pain, right? Yeah. I don't think this is a quick recovery in those around international travel, right?
My view is in 2 years, the prices we see today of Flight Centre and Webjet will be a lot better than they are today.
What we need to be careful of is that a lot of the equity market, including some of US equities, has just got this V-shaped recovery sort of priced in. And as much as I'm an optimist and a capitalist, I don't think that's likely. It's going to be it's going to take time, it'll work, but it's going to take time. So I think in every cyclical industry that's been disrupted by this, you've got a bit of time, and you can pick and choose your way through it. And actually, this quarter might be the worst. This is the quarter it's getting, no one's doing anything. I mean, even coming in here, like there's just no one anywhere. And so and it's going to take time for people to get their confidence back. So just take...
to wrap up, if you were investing in Australia, and you're a foreign investor, Webjet and Flight Centre on a 2-year profile, do you reckon that there'd be a reasonable...
I haven't done enough work on that. Does it tempt me in?
Well,
no, you can't. You can't just pull it out of the sky.
Yes, right. You can. Webjet, you pull it out of the sky.
I keep saying to you, if I want to buy travel, I'd buy Qantas, right? Yeah. Stick to the pure...
No, after Buffett.
There could be different factors at work that can preserve domestic travel. Prices will go through the roof probably because they're going to have changed everything. There are a whole lot of different players, but I think some of the resellers, the distributors of stuff that rely on those people going on
that's
overseas
a volume
fares,
on volume game. That's actually right.
I think that's the ones that could get disrupted, right? If you like travel, I'm not saying Qantas is a buy, but if you like travel, go for the pure.
The other side of that, as I've said 15 times here, if there is a price for Sydney Airport. You know, that's something that, you know, mate, it's not going to recover dramatically, but there will be a price for that one as well. But, you know, Pete, let's just put this in context. We're 2 months into this disaster, not 2 years. And for us to sit here and me to sit here unequivocally tell you what comes next is just not right. I think we've just got to work our way through it.
Charlie Aiken, Aiken Investment Management, and Paul Rickard from the Switzer Report. Thanks for joining us. Well, my next guest is Laurie Mccallister, who is the CEO of McPherson's Limited. And Laurie's company has actually done pretty well over the last 12 months in particular. And despite the fact that he certainly copped it like every other company did, the bounce back has been terrific. So let's find out what McPherson's doing and what's their competitive advantage such that it's been able to beat the coronavirus. Laurie, thanks for coming on the program.
Thank you, Peter. I think it's been an interesting time. I mean, for us, we've been through this kind of very strange period. As you know, it's a 160-year-old company, and we've been in mining and all kinds of different types of businesses. And now we're very focused in health, wellness, and beauty, and that seems to be paying out for us. So we're kind of relatively low-cost products within Maltix, which is the greener range, and grocery. We've got the pharmacy range, and things seem to be playing out for us. So we actually had a very good first half, incredibly strong January, an average February, incredibly strong March, and then a pretty good April as well. So people seem to be very engaged in our health, wellness, and beauty products that we have at the moment.
Okay, so Laurie, you know, you touched on the past. Who was it who decided to get out of the old world and get into this new world of wellness and beauty?
Oh, mate, that's a toughie you ask me, because I look like I've got an S in my chest if I say it was me. But it was a combination of the board really thinking about being focused on where the money was. And we know we will get a very capable grocery business and a very capable pharmacy business. So I inherited a very good team, and then I built a couple of extra people to come into the team to help us refine that strategy in health, wellness, and beauty. I brought some people that I worked with before at the Coca-Cola company and with Sanofi, but I was very, very lucky to inherit, you know, a great board and a great team of people and the SLT. Okay, so.
We're going to put the chart up of the stock price, which does show that you're heading really well. Then you copped a kick in the guts like most companies did, but it's a nice rebound. Tell us well, I guess I should ask you, did you have anything that was going to benefit from the fact that people needed things like sanitizers and things like that?
Yeah, no, that's a really good question, Peter. I think, first of all, before I get to the sanitizers, because obviously that's going very well for us, is I think that business that I've been considering offloading and being very public about, so there's no selective disclosure there, in baking and cooking and Maltix. It's the number one brand, Maltix, with cooking and freezer bags and garbage bags, etc. Obviously, people staying at home, you know, like most people, their kids and their husbands and wives are having lunches at work and whatnot, not during the day. Now they're all kind of in this zone. So that whole Maltix business has been going incredibly well for us. And then obviously Chemist Warehouse, who's a great customer, came to us and asked us to do a venture on a hand sanitizer business, which we've done. And that'll deliver about an extra $9.5 million. We're also doing hand sanitizers and whatnot through our other products like Akin and Maltix and Swispers. We've obviously had sanitizing products and Swispers already, and we've obviously had body wash already in Akin. So our portfolio has been quite nicely set up for this unfortunate situation. I'm just kind of keen for the company to be relatively humble in how we handle it, because we've got a very, very, very healthy balance sheet and the business is going very well. As you know, I just came out with an update to the market last week. To just revise our guidance at plus 10% on PBT. So we just need to take one day at a time, because it's very uncertain ahead of us. I'm a bit worried about the future in many ways, because you don't know how much of it has been buying up and how much of it's sustainable. So it's a difficult one, Peter.
Yeah, most definitely. Laurie, what is the most important product to revenue nowadays?
So we have we did a joint venture in November with a company called ABM, a Chinese joint venture, and that was a business that in 2017 did $300,000, in 2018 did $3 million, in 2019 it did $16 million, and we'll do somewhere between $32 to $36 million this year. So that's been a product in skincare. It's the number one cosmeceutical brand called Dr. Lewin's, and that's going incredibly well for us. And we also bought into a manufacturing company called the Aware Group. We bought 10% of them, and they've been incredibly diligent. And from a disclosure perspective, one of our directors is on the board of our company. He's also the chairman of that company. So through the ASX rules, we've had to be very cautious as to how we do that. But it's going incredibly well for us at the moment. And we're just gearing up for, literally before this call, I was gearing up for a call about 6.6, which is a big event in China.
So going forward then, we all have the uncertainty of what the economic rebound will look like, how much of normalcy will we return to, as the year progresses. What is the big positive out there for you? And on the flip side, what's your greatest concern?
I think, the big positive for me is obviously our current staple base of manicare ladies. So we're number one in 6 categories, and they're in pharmacy and grocery. And, it's about how many sets of tweezers, Peter, do you have in your drawer? Probably about 20 of them, but whenever you want them, you can never find them. So you go out and buy another $3 set. So they're not big expenses, things like that. Multics, baking, I think people are going to be more homely in how they look at life. I think people are definitely going to have this obsession with hygiene, which is great for Swispers, etc. I just look at my wife and my daughter as far as what they're doing with their hairs, etc. All those kind of things that we have in Lady Jane, etc. So as a new reset, I think things will dissipate. So that's good news. And then obviously our China business and Dr. Lewin's is going very well. Our skincare business domestically is growing 40-odd%, and obviously over 100% in China. So that's the kind of good news. The things that worry me is the FX. I'm quite exposed to foreign exchange. I buy about 50-odd million US dollars of foreign exchange from China. So I'm relatively exposed there. I think obviously you're exposed to what happens in grocery with private label and whatnot. So they're the kind of things that keep me awake at the moment. But all in all, the portfolio looks pretty balanced. And given we've got such a great balance sheet, we're very much in acquisition mode, which is I always say to people I should have green lips because I'm kissing so many frogs. But not quite got there yet, Peter.
Okay, well, one last related question. Which way do you want the dollar to go?
That is a good question. It all depends on the commodities. So because the relationship between commodity and foreign exchange has a very, very, very similar situation. So for us, for the moment, with crude oil where it is and where the Aussie dollar is, and where the relationships are with China, it's a bit of a mixed one. So I'll pause on that one. My father-in-law always told me, never bet on the FX, but the commodities piece you can see a little bit out, and you're going to get it at one point, because it does take 3 to 4 months to rally into your supply chain. But foreign exchange, as we know, the Aussie dollar through the years falls very hard, but it has a consistency over the last 60 years to climb day by day. So that's some of the facts. But how can you look at that crystal ball? Some of the other things, Peter, I think you might be interested in is we're not letting one person go from our team. We're committed to keeping all of our staff. We're focused on retaining our staff. We're actually employing an extra 6 people. We've got this concept called Rapid Response Team, which is all about people and safety, where we've offered people $25 a month on laptops, Wi-Fi, telephones, each of those, screens, chairs. We've offered them an ability to spend $100 on learning a new instrument, on learning a new language, on health and wellness, such as things such like meditation. We've offered them $200 to set up a new gym. Lots of different things that we're doing through that rapid response team, which is obviously costing us money, but it's letting people know that we are investing in them and we care for them. And then we're doing another one called Think Beyond, which is all about our sanitization business with Chemist Warehouse, with Akin, with Multics, with Woolworths, with Coles, with Swispers, which is all about building a different portfolio, which is more revised towards the issues and the hygiene considerations we will have, I think, for the next 5 years. I think they'll dissipate, but I think they'll be top of mind. We've also offered our customers 30 days extra credit terms, especially our independents, to help out the small guys who are doing it tough.
Excellent stuff, mate. Well, good luck, and thanks for joining us on the program.
Thank you very much. Thanks for having me.
Pleasure. Well, the coronavirus has hurt a lot of companies, and a lot of up-and-coming companies really copped it during that time when shareholders were so scared they just dumped stocks. Now, one company that had a really good 2019 was EML Payments. I'm talking to the CEO, Tom Cregan. Tom, thanks for joining us.
Thanks, Peter.
Look, a lot of people wouldn't know what you guys do, so explain to us what EML Payments is its main fare.
Yep. No, so we're a financial technology company. We're a payments platform that various corporates and governments use for various programs. It could be gift cards, or it could be distribution of welfare. It could be financial services. We deal with companies across multiple industry segments and kind of power the payments within those businesses. So
Okay.
I think today we've probably got maybe 3,000 programs around the world, something like that.
Okay, so in a sense, you're a behind-the-scenes business, but could you give us an idea of maybe one product that lots of Australians would know where you guys are effectively powering the activity?
Yeah, probably in salary packaging, I think, which a lot of Australians would know. So we are a B2B provider, you're right, and providing services to the likes of Macmillan Shakespeare, Smart Group, other listed providers in that space. And what we do is provide a card or a payment service to the doctors and nurses and not-for-profit workers that enable them to spend their packaged money, their tax-free portion of their salary on items that we restrict so that it complies with the tax laws. So they're free to use that, for meals and entertainment and living expenses and so forth. But if they tried to access that money through an ATM, that would be rejected. If they tried to access that money for international travel back in the day, that would be rejected. So we manage that service, and we've got about 240,000 accounts, in the market now, servicing Macmillans and Smart Group and others.
And I guess it also improves the accounting of all this, which is very time-consuming and costly if you're looking at each individual, how long they spent interstate and what they spent on, that sort of stuff. The card, in a sense, I guess, simplifies it and creates a lot of efficiencies.
It does. I mean, particularly for our customers who are the providers, the salary packaging providers, there's a lot of back-end efficiencies, because in the past, people would have used personal money, to sent that receipt in to the provider. That would have had to be tabulated behind the scenes. It was pretty manual, whereas now the software is doing 100% of that. So it's managing individuals' access to funds. It's managing where they're spending it. It's managing all the reporting. Manages all the makes the tax part of that much simpler. And so we launched that in 2016, 2017, and recently completed a launch with the New South Wales Ministry of Health for all of their various health departments, and recently signed a contract with the ACT Health Department as well. So that's one that I think quite a few Australians would be familiar with, given quite a few access salary packaging benefits.
All right, so when the coronavirus hit, when you looked at the potential slug to your business, albeit short term, what were you thinking? How was the business going to be negatively affected in the short run?
Well, in the immediate sense, about 55-60% of our business comes from gift cards that are sold in real estate, in property, in shopping malls that are owned by real estate trusts and so forth. And that in the month of March and April just substantively closed because of social distancing and forced closures. So that percentage of our revenue went from from a pretty strong position to effectively nil, on March 10 onwards, which is a pretty dramatic, very dramatic hit. We had concluded an acquisition in the UK with an Irish business that operates in the UK and Ireland, which we concluded on March 31, which is a pretty sizable business in its own right. So we knew the impact would be short and pretty painful on the mall side, but we also knew that we had a pretty good asset coming into the business, which it did on March 31. So we felt like it'd be doom and gloom there for 90 days, but then we'd be able to trade out of that reasonably well.
Yeah, and the market has responded positively. I guess since March 23, when the market responded positively, just about everywhere. Looking down the pipeline, Tom, some people are saying, well, I don't agree with them, but a lot, as you know, everyone becomes a social expert. Like, we're all experts on viruses now. We're all experts on what people are going to do in the future. I noticed that even Warren Buffett said yesterday that he's dumped airlines because people aren't going to travel like the way they used to be. But he, of course, made the reference that he was dying to travel. He hasn't travelled 7 weeks. So we make guesses. Some people imply that people won't go to shopping centres as much as they used to in the past. Are you factoring that in and saying, well, we'll be looking for growth in other areas other than shopping centres, or do you think that there's exaggerations around the changes that will happen to us?
No, I think they're reasonable. To be honest, I think I think they do recover, but I think that recovery might be 2.5 years away. I think that what they were in some countries, malls are a strong part of the business, so of the kind of social culture. So the Nordics remained open, funnily enough. But Germany, UK, Italy, these are pretty large markets for us. I think there'll be a shift to online that comes out of this isolation mode that I think is pretty hard to dispute. I think when malls reopen, which effective today in Texas and other states in the US, they're opening, but still with social distancing. You've got question marks over the viability of merchants within those malls. I mean, only depending on whether it's URW or others, there's only 20 or 30% paying their rent. So how viable are some of the merchants within the malls? I've read articles about delays to supply chain channels and the merchandise that's in the stores. So I think they do recover, but I think that part of our business probably takes 2 to 2.5 years to recover.
Yep.
But we've always had a view of wanting to keep a very diversified business that isn't too exposed to one vertical, but
Yep.
But arguably that one got too big for us at about 55%. So as that comes down and we focus on other verticals, then that may take, as I said, 2.5 years to get back to where it was. But plenty of other things will fill the void.
Yeah, and is there a vertical, as you call it, for online that you can get some equivalent, inverted commas, card in an online way?
Yeah, we do support those, but and normally they would be a part of the revenue mix, but given the properties are closed, they weren't even selling them because they'd be selling gift cards without the ability to let someone redeem them. So as they come back, as the malls start to reopen again, they will be selling them online. But then I think it just comes down to traffic, and I also think, I'm sounding negative because I think they, our shareholders should think of it as a 2 and a bit year recovery for that segment. But recessionary impacts have got to be significant. I mean, the rest of our business, things like salary packaging that I talked about before, is not a discretionary item. That's part of somebody's salary that's being used on everyday items, on food and entertainment and living expenses. In Europe and in Australia, the digital banks that we're partnering with, banking is not discretionary. That's people using that as their primary bank account. And so part of our business is non-discretionary, but part of it that is the malls. And I think that if you've got 30, 40 million people unemployed in the US, and you've just got to think that there's a recessionary impact on consumer disposable income and on discretionary spend, which is a gift card.
Okay, so
I think that
Yeah, sorry, Tom, for interrupting. But what then?
No, you're right. Yeah. You go. No, sorry.
Yeah, so therefore, what is going to be the blue sky that you guys are going to pitch towards? You've accepted that there's a recession effect. There's going to be a shopping centre effect, and you've said you're well positioned with the other parts of your business. But the Irish acquisition, is this going to be something that's going to be a bit of a fillip to the organisation?
Oh, definitely. Yeah. I mean, the logic behind it's funny how things like COVID, just hit you unexpectedly. But the purpose of that acquisition was to continue to broaden the tech platform and broaden the customer profile. 42% of their revenue was welfare or government payments related. So the UN, for example, is one of their customers. UK government is one of their customers. That part of the business probably goes up now as a result of COVID, just given more government spending and more subsistence and welfare payments to kind of vulnerable individuals. Another 42% of their business was digital banking, so the use of using their technology for someone to use as an alternate to their primary bank account, which I think is a long-term driver and will outlast any COVID impact. So only a small part of their business is COVID impacted. But the strategy was to buy them back in November when we announced it, and to broaden the tech and the customer base. And I think that would have been good ordinarily, and with COVID it becomes great because it just becomes the need for that becomes more urgent. Obviously, with malls now on a recovery path, and I think since January they're not seeing any real drop off in sales activity. They're not seeing any real drop off in implementation programs that are already in their system to do. And outside of malls, neither is the previous EML business. So I think since January, probably across multiple different segments, whether it's consumer finance or fintech or digital banking or others. We've probably signed 20 customer contracts, I would think, in that period of time for programs that will launch and start to generate revenues for us. So that was already the game plan, but it just becomes far more urgent. You've just got what would have been a plan to do that anyway just becomes concertinaed and becomes more urgent to get traction on it quicker.
Tom, just as I was listening to you, my last question, it kind of reminded me that what you're talking about, the cards you're talking about, are in many ways like the old coupons that people had during World War II and the Depression, where government basically gave coupons that could be redeemed at shops for particular staples. Is that a relevant kind of comparison?
Oh, look, in some countries it is, yeah, for sure. Like the Spanish government is talking to us. I will say with government, there's a lot of urgency on their side as well to think about how they're supporting their economies and how they're supporting their people. But whether it's the Spanish government, the UK government, there's a lot of Italy. We're doing programs with governments. We're doing programs with charitable organisations. In the US, for example, we launched one with United Way, which is a Uniting Church charity, which distributes money to people that they just consider vulnerable. So people in need of emergency kind of assistance. It's totally mobile driven. So if you're getting $1,000 for groceries or what have you, it's a digital token sent to your phone. There's no physical card. There's no plastic. It's sent to you. You click a text. You've got it, and off you go and spend it. So we're seeing a lot of that. We're seeing that in domestic violence charities in different parts of the world. So there is that opportunity in that market, but it's a feel good story because there's a commercial opportunity, but there's a very positive social story to it as well.
Tom, thanks for joining us on the program, and good luck going forward.
Good on you. Thanks very much.
Well, thanks for joining us on the show this week. And let me tell you this, in case if you like the stuff, there's a thing called the Switzer Report, and we actually have some of the best analysts of the market, some of the best stock market tipsters in the country who really do put out some fantastic stuff. The Switzer Report comes out on Monday and Thursday, and a really big one on Saturday, which means I get up very early on Saturday morning to write it. But if you're looking for some inside information on what's going on in the stock market and how you can make some money out of the stock market, go to www.switzerreport.com.au. That report, you can get a 21 free day trial. I think you'll find it very, very interesting.